Bitcoin is down more than 14% in just the last 4 days, but fear not. Tonight, I'm going to pull back the curtain and show you exactly how I have been profiting as the prices have been selling off. So we're going to talk about 3 specific strategies. Number 1, we'll talk about trading the perpetuals futures market on GMX. It's a decentralized exchange. I think you're going to like it. Number 2, we'll talk about shorting crypto on a lend borrow protocol. Specifically, I use Aave. It's my favorite lending and borrowing protocol in DeFi. And number 3, we'll talk about running a liquidity position, how it loses value as the price drops, but those hedges, the short positions, can actually compensate you and you're earning fees all the way down. So without any further ado, let's get into it. Remember, if you're doing DeFi, you're doing it the right way. Self-custody is the way to do all of this. And with self-custody, you have to have a seed phrase. That's how you set up your Web3 wallet. We have a tutorial on the channel, shows you exactly how to set up that Web3 self-custody wallet right over there. Keep that seed phrase to yourself. So that is the number 1 rule in crypto. If anybody gets a hold of that seed phrase, they are going to steal all of your assets. They're going to own your wallets and they're going to drain them. So keep that seed phrase to yourself, including the most popular scam is they will convince you that they are calling you from Coinbase or Ledger or it's some kind of tech support. And they'll convince you to go to a website and enter your seed phrase into a website. So there's never ever a legitimate reason to give your seed phrase to anybody or anything, not a website, not an app. Just keep it as a physical copy, not a digital copy, and keep it to yourselves. It's so tragic when I hear about people losing thousands or hundreds of thousands of dollars in crypto because they gave their seed phrase to a scammer. So please don't fall for those scams. And without further information about that, let's go ahead and talk about these 3 strategies. So before I get into the specific nitty-gritty details of how I've actually been generating profits as the price dropped, I do want to explain why we came to be bearish in the first place. So we never know what the market is going to do. There's never certainty in markets, but we can look at different technical patterns that play out on the chart. And for that, I'm going to zoom out a little bit here on the daily chart of Bitcoin, and I'll drag the chart over here to the right. So throughout the course of 2024 and into 2025, it was quite bullish. Very simple to see the pattern of higher highs and higher lows. And when we got the drop in October and into early to mid-November, it looked like it was just another pullback. For example, if we look at this drop right here, this dropped from, if I can get it, that's close enough, dropped about 30% in January of 2025. But then we started rallying again and the price was heading up. Now, right here is where things started to change. And in our community, myself and the folks in our community at Overseas DeFi, we flipped the script once this big drop happened. So this was a larger drop here, much more than 30%. I just can't seem to get those measurement points from the very peaks today, but that was a more than a 35% drop from the high in October. This changed things right there. As of November 21st is when we first started to implement these hedge positions and the short positions to profit on the way down. This is where we flipped to a bearish stance on the market. Now, I won't get into the details of my short positions that I had in this area, but I was selling out of a lot of my Bitcoin and ETH and other assets. I was setting up a short position on a perpetuals exchange called GMX. We will get into that. And I was also shorting crypto in my lend and borrow position. We're going to get into the details on both of those strategies as well, so that when this next drop came, I was able to actually collect some good profits. And I worked on a report this last weekend. We're looking at raising some capital to expand our business. And one of the things we're going to do is manage a crypto treasury, just like we do in our personal accounts. And we're going to do that for the overseas DeFi business. And we want to have some proof of concept, some track record. So I put together this report from November 21st. Again, that's when we flipped bearish, up until just this last weekend when I used AI to create this report. And we're going to talk about the liquidity positions that I was running during this time frame. And a liquidity position is inherently bullish. If the price goes down on your liquidity position, you will lose value. And you can see here during that big drop from November 21st down into the February 5th low and beyond, the principal value of the liquidity position dropped by 30,000. But simultaneously, I was collecting fees on that position to the tune of almost $16,000 in fees. Beyond that, we had two programs used to hedge the market and hedge that risk associated with the liquidity position. The net result of my hedging activities was over $40,000 in profits. And the net result, when you factor in the fees that I earned, the loss that I took on the value of that liquidity position, and the profits that I had on the hedging, the net result was almost $26,000 in profits, while the market absolutely tanked. The main asset that I was using during that time span, still using today, was Ether. So the Ethereum coin here from November 21st in this area dropped all the way down to there. And this is where I racked in the majority of those profits on the short positions. Okay, so let's get into the strategies, and please feel free to ask any questions as we go along. We've recently released a couple of free videos on the channel just 2 weeks ago, and then last week as well. This is meant to be a series of videos. I'm working on the third video. It's going to be released very soon. This is the complete process, step by step. It's going to take you through the very beginning, and by the end, you're going to have a full crypto and DeFi portfolio where you own assets, hopefully will eventually appreciate in value, but you're also, this is important, you're also generating cash flow every single day. And that is the third video is going to be on that. It's going to be on how to set up a liquidity position. Spoiler alert, we actually already have a video on how to do that. This video right here, a little bit long, 16.5 minutes. This is going to show you in detail how to set up a liquidity position, but I'm going to do it again. And I'm using a demo wallet, which I set up in this first video and extended in the second video. So anyway, let's get into the strategy. Please feel free to ask any questions as I go through this. Let's talk about the perpetual futures trade. So here is GMX. This is a decentralized exchange. So all you need to do is have a crypto wallet. We use Aave here. This is my favorite EVM Web3 wallet. You connect your wallet to the exchange, and as long as you have some USDC or USDT in your base or your Arbitrum wallet, you're able to place trades on this exchange. Got into this a little bit last week. So I wanted to specifically show you the position. You can see I shorted the market here. This is Ethereum, and I shorted the market here to the tune of about $36,000 worth of ETH short. Short means you're betting on the price to go down. So that was about 36,000. And then I added on to the position. It was looking like it was going to let go pretty soon. So I shorted an additional chunk right there at 2,300, a little bit over 2,300. The entry price here was ideal. Just under $2,400 was that first position. That was about 36,000 in the short there. And then I added on an additional 6,000 right over here. And then I just wrote it down. Now, as the price went lower, you never know when it's going to turn around. So what I like to do is scale into and then scale out of a position. So I had about $42,000 in size. This short position was about 42,000. I was using, if I recall correctly, it was 3x, maybe it was 4x leverage. I never get too crazy with the leverage. I certainly wouldn't go anything higher than 10x leverage. But in this position, I was running, I think, 3 or 4x leverage. Now, that leverage factor, that allows you to increase the size of your bet. So even though I only brought, if I recall correctly, I only brought around $10,000 or $12,000 of capital into the exchange, into the trade. That was what I posted as my margin. I was able to place a bet that was, like I said, about $42,000 in size. So you're able to amplify the size of your position. Again, think of this as a bet. You're betting that the price is going to go down. And if it does go down, you make profit as the price goes your direction. As it goes down, you're making profit each time the price goes a bit lower. Of course, the opposite is true. If you bet short, you want the price to go down to get profits. If the price, in fact, goes up, you're going to start racking up the losses. So as the price was going my direction, I began to have profit on the trade. What I like to do is take some profits, but let the rest of the position run. So you never know when it's going to reverse, but what you can do is take some amount of profits, put that in the bank, and then see if the price is going to continue, if it's going to, in this case, continue trending lower and give you a deeper target where you can take off some more profits, take some more chips off the table. Literally, I love to use an analogy for futures trading. It's just like going into the casino. You're betting on red or black. You're betting on the price goes down or the price goes up. So short is betting that the price is going to go down. Long is betting the price is going to go up. In this case, I was obviously betting that the price would go down so that I could profit as the price went down, because I knew that other parts of my portfolio were actually going to be losing value. So the short position wasn't necessarily in isolation, it was a bet on the price going down. But when you look at it holistically with my whole portfolio, it's more of a way to reduce the pain factor. So rather than losing 30%, maybe I only lost 5% of my portfolio or something like that. I suppose I could look at the way the numbers worked out, but it's complicated because, as I said, back in November, early December, I actually sold a lot of my assets in preparation for this bear market that we're in right now. So when price reached this level, you can see I closed out part of the short position at 2168. I was using technical analysis to make this decision, and 2168, if you can see here on the chart, there were some lows in this area, specifically right in this area. We had a couple of low prices here where the price bounced higher. So I figured that might be a place where the buyers would step in and the price would pivot. It would stop going down and return it back up. So I figured, let me bank some partial profits on this trade, which is exactly what I did. So here I had a $42,000 position. I took off half. So I banked half of my available profits at that price, and I let the rest run. The next level of support you can see here, just above 2,000. That 2,000 level for Ethereum was what I figure a psychological level. A lot of times markets will turn around at a round number price. $2,000, it's a nice even round number, and a lot of people will see that price and they will act. They will think, oh, that's a good bargain. Let me go ahead and buy some ETH now that it has dropped down to that $2,000 level. And beyond that psychological level, we also had some technical levels right around that $2,000 price. So for example, right in here, these bounces here, just above 2000, this one at 2063, and then this price action over here, right in that zone about 2000. So when price was coming into close to being into $2,000, I went ahead and took another partial profit. You can see right here, I closed another 1/4 of the position. So I believe it was about $11,000. I had 42. I took off 21, and then I had 21 left. So I took off another 11, and then the last one was just under 11,000, 10,000 and change right here. Now, the last tranche or the last chunk of this short position was right here. And I'll call your attention to this bit of price action right now. Now, this is a 1-hour chart. So for multiple hours, the price of Ethereum bounced very hard. And I thought this is a decent, there's a decent chance that the localized low is in, and maybe we'll bounce for a few days, maybe a week or two, where I'll have a chance to scale back into that short position at higher prices. And when you're shorting the market, the idea is you're selling at a high price and then you're buying back at a low price. And that's going to come into play when I talk about shorting on a lending protocol like Aave. So the question is, if you're selling at a high price and then you're looking to buy back at a lower price, how does that even work? How can you sell something first and then buy it back later? It makes no sense. Usually, I mean, when we think about trading or investing, you have to buy something and then you're looking to sell it second. You buy it first and then you sell it later on, hopefully for a higher price. With shorting, it's the exact opposite. So how do you sell something when you don't have it yet? And the answer is you borrow. It works the same way in the stock market. You can short stocks and you don't really see the mechanics under the hood. But if you have a trading account, for example, Charles Schwab or E-Trade or whatever, if you have that brokerage account and you want to short a stock, what happens under the hood? The broker actually lends you those shares. So if you sell 100 shares that you don't already have, you're shorting the stock. Where do those shares come from? The answer is your broker lends the shares to you. You don't even have to do anything. You just click the button and you short the stock and away you go. So they lend you the shares and you sell those shares on the open market at whatever the current price is. And then if the price drops down lower, you buy the shares back from the market at a lower price. And then again, under the hood, those shares, that loan that your broker gave to you, that gets repaid by giving them the shares back to the broker. In crypto, it's the same way. On a lending protocol, we can borrow ETH. So the second strategy, I shorted on GMX. This is a perpetual futures exchange. The second strategy was on Aave. Now, at the moment, I still have almost 13 ETH borrowed. This number used to be about 22. Okay. When the price of ETH was relatively high, I'm talking about 2,300 up to 2,400. What I did is I borrowed ETH against my collateral. I have collateral here posted. And if you've never used a lending protocol in DeFi before, we do have a full video, just released that last week. And this is going to give you the step-by-step of how to lend and borrow on a DeFi protocol. So what I did is I borrowed ETH from Aave. I had collateral already. I borrowed the ETH against that collateral. This is an over-collateralized loan, meaning my collateral is more valuable than the loan that I'm taking out. One second. So that was the first step. I told you I'm going to give you the full strategy, which if there's questions, we can go back to GMX and I can show you exactly how that works to set up a short position on Aave, or excuse me, on GMX. It's fairly simple. You just choose short. You can use a market order, a limit order. Market order just means you're going to take whatever the price is right now, and that trade is going to instantly fill. Limit order means you get to designate your preferred price. And if the price does in fact go to that level, then your trade gets executed. So you would bet short rather than long. You're betting the price is going to go down. You have to post some collateral. So same kind of deal. You have to have collateral here. It's called margin. You have to bring some money to the table. Again, think about that analogy. If you want to play blackjack in Las Vegas, you got to start out by bringing some money and setting it on the table, and that's your chips on the table. Margin is the same thing. It's the money you're putting at risk in the trade, and then you're able to set up your leverage. If you're just starting out with GMX or perpetual futures, I would go with something very conservative, like a 2x or a 3x leverage. That would be fine. Definitely don't go any higher than 5x at the most. That gives you that amplification. So you can see here, even though, like, if I wanted to place $1,000 of margin on the table, if I'm putting $1,000 on the blackjack table here, so to speak, if I use 3x leverage, the size of my bet is actually 3 times that amount. So in this case, like, the current price of ETH is, what is it right now? About $17.50. So $3,000 would equate to about 1.7 ETH. So that would be the size of my bet based on the margin that I placed and the leverage factor. In this case, again, a limit order allows you to designate the exact price. So let's say I want to short the market if and when the price goes back up to 1,800. I actually don't have any USDC in this wallet at the moment, but this gives you the raw ideas. In this case, if I waited for a higher price, it's a little bit less ETH, I would now be controlling about 1.6 or 1.7 ETH. So that's the size of my trade. And now this is a bet that continues on. You get to choose when this bet is over. If you sit down at the blackjack table and bet on a single hand of blackjack, the dealer deals the hand, you win or you lose. It's over in one hand. In the case of betting on price in the futures market, it's a continuous bet. And as long as that trade or position is open, the price affects your chip stack. I put $1,000 on the table and I'm controlling, let's just call it 1.7 ETH. That means if the price goes my direction, if it goes down by $1, well, my trade is 1.7 ETH. So I actually make $1.70. Okay, if it goes down $100, I make $170 of profit on that trade. Doesn't mean it's there to stay. If the price goes back up, that profit erodes. So as the price moves up and down, it's basically like adding chips to your stack or taking them away. If the price goes your direction, more money gets added to your stack. If the price goes against you, the money gets removed. You only have, in this case, in this example, I have $1,000 at risk. That gives me almost like an allowance. The price can only go against me so far before I'm going to run out of chips. So let me give you a map. Let me give you the math on that example. We said that we're controlling 1.7 ETH, right? That's based on the $1,000 we put at risk, the multiplicative factor of 3x, and the limit price that I set. If I have $1,000 on the table and the price moves against me, it's $1.70 that I lose for every $1 that the price goes up. So if I divide this by $1.70, it tells me that I can only withstand a $588 price move. So if I bet short, I'm betting that the price is going to go down. If it instead goes up, it's only allowed to go so far before I run out of chips. And that's how the math works, roughly speaking. Now, there's fees, there's a funding rate that's involved here. So it's not quite exactly that amount, but that's the basic idea of the way margin works and the way your trade will play out. If the price moves your direction, you're going to gain money. If the price moves against you, you're going to lose money, but you only have a limited amount to lose. Once that chip stack runs out, you're going to get liquidated on the position. It's going to get automatically closed. Okay, so I beat that one to death, but hopefully that helps for you to understand the way to trade the perpetual futures. By the way, it's just futures. Perpetual just means that these contracts don't have an expiration. Normal future contracts have an expiration date. These ones don't. They just continuously go on and on and on. That's how crypto perpetual futures work. There's no expiration date. Anyway, that's how you can short the market and profit as the price is moving down. If you suspect we're in a bear market, which again, I suspected we were in a bear market ever since that big drop into November 21st last year, you can implement these short positions on GMX or different perpetual futures exchanges. There are centralized exchanges, nothing really in the US yet. But I like GMX because everything is decentralized. It's trustless. It's smart contracts. And I can control everything with my self-custody wallet. That is how you can trade the futures and benefit as the price goes down. Now on the Aave, back to the Aave example. I'm talking fast, so let me wet my whistle here. Hey, I appreciate 21 live viewers. That is that's the best turnout that we've had in a while here. So I appreciate all of you tuning in live. Make sure to like the video and comment in the chat. Again, if you have any questions at all, please do not hesitate to interrupt me. I'm more than happy to answer any DeFi or crypto related questions you might have. Last week, somebody asked about the Forex pair, gold USD. And I'm like, nah, it's a little bit outside of the scope here. But if you have a question about how to do things in crypto and in DeFi, I am your guy. Okay, so let's talk about my short position on Aave. And again, let's go back to the report. A lot of my profits from the hedging was based on the GMX. GMX total was 21,800. And then the synthetic short position on Aave as of May 31st was about 18,800 of profits on that trade as well. So how did I do that? I'm going to use the most recent example, which we've had a couple of big legs down on Ethereum. Like I said, I started shorting in late November, early December in this time frame. That big drop on November 21st, that was the big red flag. Uh-oh, we're in a bear market. Not for sure, but pretty high confidence that we were in a bearish market. I better start implementing some short positions, some hedging to cover my butt. New to this stream, which platform do you recommend I open account for trading crypto futures? So that's one of the nice things about GMX. By the way, thank you for the question. That's one of the things I like about GMX. It's a decentralized protocol. So there is no account. Literally what you do is just connect your Aave wallet. My wallet is already connected here, but if this was your first time going to GMX with your EVM wallet, which again, we like to use Aave here, rabby.io is the website for this app. You connect your wallet to GMX. There's no account. There's no KYC. None of that. If you have some USDC or some USDT in your wallet, you'll be able to place trades on this protocol. So hopefully that helps. And welcome to the stream. Glad you're here. Okay, so where was I? So I did a bunch of shorting in this area. I lacked the imagination that that ETH would drop this low. So I actually took all of my profits. I think the lowest price where I cashed in the final short position, covered the final short position, was around 2,500. In those days, I thought that would be pretty close to the bottom. We had a $2,600 low right there that stood out for a while, and I really thought the buyers would come in. But anyway, I'm not going to go over those trades because those were all said and done. This trade here is still playing out. So as we bottomed and started grinding higher on Ethereum, I became interested in rebuilding that short position. So what I did on Aave is I had this collateral, and maybe wasn't this exact amount, but I had Ethereum, I had Coinbase Route Bitcoin as collateral here, which gave me the ability to borrow capital against that collateral. And the wrinkle here that I'm pointing out is borrowing a volatile asset. That's the unusual part. Normally, people are invested in crypto because they're bullish, and they think about crypto in terms of number go up. And if you're bullish on crypto and you're taking advantage of a lending protocol like this, you're going to configure your position in a bullish way. How does that work? If I'm bullish on Bitcoin and ETH, I'm going to put my Bitcoin and ETH on this side. This is my collateral. I'm going to post it over here. I'm going to supply it. These coins still belong to me. I just have them as collateral right now. If I wanted to get them out, I could. I just would have to pay back the loan. That's how it works. But the fact is, they still belong to me. And the important part of that is that if I'm bullish and the price does in fact go up, I am benefiting from that price appreciation. These assets are going up in value as the price rallies. Okay, so that's the first part of a bullish configuration. Let's say I have $100,000 of crypto here. If the market goes up 50%, great. Now I have $150,000 of crypto posted over here. Again, the bullish configuration, what are you going to borrow? Well, if you're bullish, you're going to borrow stable coins. That way, let's say you borrow $50,000 of USDC. The value of that loan doesn't change over time. Now, there is a small interest rate, and that interest rate is going to accrue to the loan. So your loan will slowly go up in value. But if we're bullish, if the market is going up, and going back to that example, my $100,000 of crypto rallied to 150,000, my loan is still 50,000. And so I've just realized a big jump in my equity. I started out, I had 100,000 in crypto, 50,000 in loan. My equity is 50,000. But then the crypto appreciated. Now I've got 150,000 in crypto. I still owe 50,000. My equity increased to 100,000. Okay? So that's how you would structure it if you're bullish. I was not bullish. I was bearish in November, in December, last month, the month before that. So rather than borrowing USDC, I borrowed ETH. Now, going into this, most of my debt, maybe all of my debt after I closed out all of my shorts. Yeah, that's accurate. I closed out all of my shorts in this area. Like I said, lack of imagination to understand that ETH could drop way down to 1700 and change. I wish I had hung on to more of my shorts to cash in even more profits on the way down. But I made a good amount of profits shorting Bitcoin and ETH in this area and covering the short in this area here. So by the time we got here, my debt was pure USDC. I didn't have any ETH debt. I didn't have any Bitcoin debt. I didn't have any Aave synthetic short positions. Okay, so that was, you know what? I'm going to make this so much easier than just talking and talking and talking. Let's pop into, this is the Overseas DeFi app. We have a full portfolio tracker. We've got the Overseas DeFi AI agent fully trained on all of our strategies, all of our content, everything that we've ever done within Overseas DeFi went into building this brain. So this is part of our Overseas DeFi community program where you can join the community, $97 a month, cancel anytime. You get this app, you get the full portfolio tracker, you get the Overseas DeFi AI, and part of our portfolio tracker is right here in the lend borrow. You can see both of my lend borrow positions. I'm going to use this tool here. This is our liquidation simulator, where you can come up with all sorts of different scenarios of how you can structure your lending and your borrowing. So let me make this a lot easier than all these examples that you have to keep track of. And this won't necessarily be the exact numbers of how I manage this position, but it'll be close enough. So first of all, let's move the price back up to where it was a few weeks back when Ethereum was trading. Let's put it right in the middle. It was trading between 2,300 and 2,400 Ethereum. Okay. So this is our starting point. And back then I didn't have any ETH debt. So let's zero that out. And let's say I had 60K. Now I don't remember exactly what I had, but look at this position. My collateral is about $136,000. My debt is about 60,000 USDC. If the price goes up, price goes down, this debt stays the same. I wish it would just use an exact dollar, but it's using like a little bit less than a dollar. So it's close enough to 60,000 of debt. Okay. Now, if my debt is pure USDC, look at my loan to value ratio. There's my liquidation threshold. Watch what happens when the price drops. So every time I click here, the price goes down by 1%. My LTV is climbing. That's my loan to value ratio. And you can see how it's approaching the liquidation point. Let's fast forward this a little bit. My debt doesn't go anywhere. It stays at 60,000. My collateral, however, is dropping fast because the ETH and the Bitcoin is going down in price. And let's see here. Right there, if ETH drops to 1,265, boom, liquidated, done. Do you trade live or send signals via Discord, since I don't understand price action or fair value gaps? Or I know what you're talking about, fair value gaps. What's that guy's name? ICT. I've watched some of his videos. No, I don't send any signals. I'm not using Discord or anything like that. I've been trading for more than 15 years. I've done a lot of day trading. Don't do so much day trading anymore. DeFi is just so much easier and so much more consistent and so much less stressful than day trading. But yeah, I basically do price action analysis. I look at the price action. I do simple technical analysis. I mean, nothing crazy, trend lines, horizontal levels of support and resistance, that sort of thing. And I on GMX, I just manually trade the price action, based on my read of the market. So hope that helps. Now, let's get back to this example. If my debt was purely USDC, I'm going to get liquidated here as the price drops down to 1,246 ETH. Oops. Okay, so now let's go back and let's paint a different scenario which reflects what I actually did. It's not going to be perfect. The numbers are not necessarily exact. But let's go back to where ETH was trading at 2350. There we go, right there. And I'll tell you what I did. I went to Aave. My wallet was connected, and I borrowed some ETH. You can see right here. If I wanted to, I could borrow 10.99 ETH from the protocol right now. One click, one signature, it's done. And when you borrow an asset from Aave, this is DeFi. This is self-custody. Those coins come out of the smart contract and into your wallet. They're mine. When I borrow them, they're in my wallet to do with what I please. So what I did is I started by borrowing some ETH when I thought in my mind, this is a high price. This price is probably going to go down from here. That's what I was saying to myself when ETH was trading at $2,300 to $2,400. I thought it was a low risk entry point at which to short the market. Okay, so let's get back to the mechanics. I borrow some ETH. The ETH comes out of the smart contract. It hits my wallet. It's now in my wallet. Step 2, I go to a decentralized exchange. You can use PancakeSwap. You can use Uniswap. I like a DEX aggregator called 1inch nowadays. By the way, if you're looking for these different websites, please do not do a Google search. I had a client one time that he was in a hurry. He did a search for a particular bridge that he wanted to use to bridge some coins from one network to a different network. And he just quickly did a Google search and clicked on the number one response, went there, connected his wallet, and tried to bridge $1,000 of ETH, and it was gone. So they will set these scammers. They're so nefarious. They'll set up these fake websites that look just like the real thing, and then they'll literally pay Google to have that scam website show up at the top of the list. Okay, so Google is to be avoided. What you want to do instead is use the DApp search function that is built into Aave. This is a free app. This is a browser extension. Click on this little settings icon right here, this little settings button. Click on search dApps. And what this is a complete directory of pretty much every DeFi and crypto website under the sun. Okay. And this is going to give you the official, real website address, the URL. So you can rely on this to search for your different protocols. For example, PancakeSwap, Aave, GMX, Uniswap. Again, I've been using a protocol called 1inch. There it is right there. Okay. So getting back to the Aave strategy. I borrow the ETH. It comes to my wallet. I go to 1inch, PancakeSwap, whatever, and I swap the ETH for USDC. So that's the second step. I sell that borrowed ETH at a high price, or what I think is a high price, right? You never know, but you can think. You can have an opinion. My opinion was this is a high price. I sold that borrowed ETH for between $2,300 and $2,400. So we'll just split the difference and say we got $2,350. The third step involves Aave again. So the third step is I take that USDC. I just sold ETH and I swapped it for USDC. Now I have USDC in my wallet. So now I go back to Aave and I repay my loan. So I'm acquiring ETH debt, then I'm reducing my USDC debt. So I'm not changing my overall debt amount. I'm just changing the composition. I'm mixing the debt now, and I'm acquiring more ETH debt and less USDC debt. And I'm going to show you how that actually plays out if you're right. If the price is high and it does go down, this is how you're going to profit. So again, I'm going to use the app because this makes it so much clearer. And this is a very, very handy tool for you to be able to look at your position. My wallet is connected. You can see my numbers are here. That's because this app connects to my wallet. It can see the contents of my wallet. It can see all of my different positions. That's how we built this app. It's real-time portfolio tracking and more, because you can use this simulation tool to play out different scenarios, whether the price goes up or down, or what I'm going to show you now is how to swap the debt. That's called a debt swap. So I started out with $60,000 in USDC debt, but then I swapped some of the USDC debt for ETH debt. Now we call that a debt swap here in the protocol. I'm going to make this a little quicker, and I'm going to do 2 ETH. So we're swapping 2 ETH for, in this case, 4,704 USDC, because that's what the price is. So every time I borrow 1 more ETH, I take it to 1 inch and I sell it, I get 2,352 USDC. So then I take that 2,352 USDC and I reduce my USDC debt. So watch these 2 numbers right here, and hopefully I click on the right button. I always get confused whether it's the plus button or the minus button. That's the one I want, but let's try this. Nope, that's obviously the wrong button. Let's try this one. I always get it wrong. So if I click this, again, watch these 2 numbers. See how my ETH debt, and it says WETH, that's just wrapped ETH. It's the same thing. It's just the token version of the Ethereum coin. My ETH debt went up by 2 coins, and my USDC debt went down. Again, let's go back to the mechanics. I borrow 2 ETH. I take it to PancakeSwap and swap it for 4,700 USDC. I then take that 4,700 USDC and pay off my loan. So this number doesn't change. Let me do it again. Watch this number this time. No change. Because it's the same dollar value. I'm just migrating the debt. I'm reducing my USDC debt while increasing my ETH debt. Now, I understand mechanically I had to do 3 transactions. Aave actually has a debt swap function built into the smart contract. I don't like it. I've seen where it made some errors and did weird stuff, so I stay away from the debt swap function. Also, you don't get a really good exchange rate, and you pay a little fee with it as well. I do everything I can to avoid fees. That's just how my brain works. I'm very miserly, and I know how to do this stuff. So I figure, why spend fees? I can just do it myself. So what I do literally is 3 transactions. Again, number 1, borrow some ETH from Aave. Number 2, swap the ETH for USDC. And number 3, pay down my USDC loan. So let's go through this a little bit more. And my recollection is I ended up shorting 22 ETH. So let's go through this. Every time I click this button, my ETH debt is growing by 2 ETH, and my USDC is dropping by 4,730. The price, yeah, the price must have just gone up a little bit. This updates in real time. This app gives you the real time prices. So now it's 23.65. Same difference. Every time I click this button, my ETH debt grows, my USDC debt shrinks, but the total debt amount is staying the same. Let's keep going. There we go. So by the time I was finished with that process, and these numbers are not perfectly accurate because obviously my debt was more than 8,000, but close enough. Now I'm still $60,000 in debt. You borrowed 1 ETH, not necessarily the cost. Convert it to USDC, pay down debt, and pay back 1 ETH while netting the delta. Yeah, and you're spot on with that. Absolutely correct. But you're you're getting a little bit ahead of me. We're going to play that out though, for sure. And that's the next part, really. So I've done all of the debt swapping I wanted to do. And this is roughly where I was back in March and April. Now, what happens? Now the price starts to drop, and it's been dropping, right? We're down 15% on the week, 14 or 15%. So this is where I was shorting by way of Aave and GMX. I did both. And as the price dropped, that's when I started to unwind the position. So what does that mean? So whenever you're short, in order to close the trade, we call that cover. You're covering your short. You're covering the loan that your broker offered you when they loaned you the shares. You're covering that loan. You're covering that debt. So when we close a short position, we say we're covering the short. So as the price started to drop, I don't know why I just went on that tangent, but it's not important. As the price was starting to drop, that's when I started to buy ETH back at a lower price. So let's play that out. Let's show the real impact that is possible. Of course, I covered this debt in tranches. I unwound the short position in little chunks as the price went down. I don't have a crystal ball. I don't know exactly where the bottom is. So you got to take profits as it goes your way. It would be irresponsible to not cash in at least little pieces as the trade goes your way, in my opinion, anyway. So where we are, let's go back here. So I did all that debt swapping when the price was what I thought was relatively high. And then in fact, the price dropped. And nowadays we're lower than $1,800. Let's just do an example. Let's be more conservative. And let's say the price only dropped down to 1,900. Now you and I both know it dropped further than that, but let's do this as an example. Let's go one more click. Okay, 1888, close enough. Now, when I go the other direction, or when the price has actually dropped as I predicted, now it's time to take profits. Now, I glazed through something right there, which was not what I wanted to do. Let me go back because I wanted to point something out. So there's the 2350, and there's my roughly $60,000 in debt. Now, every time I click this button and drop the price down a little bit, look at this number right here. See how it's going down? The reason it's going down is this is dollar denominated. This is the dollar value of my debt. In actuality, I don't owe $48,000 here on the ETH. I owe 22 coins. I have to pay back this ETH loan in ETH. I borrowed 22 coins. I have to pay back 22 coins. But as the price drops, the dollar value of that debt drops. And that's what you're seeing. Every time the price goes down, the dollar value of my debt obligation keeps dropping. This is how we're making a profit as the price drops. This is the second strategy. As the price drops, the dollar value of my debt obligation is being reduced. So it's not exactly profit, but you're still saving money. You're reducing your dollar denominated debt obligation. That's a form of profit, right? So let's keep going. And let's take it down to 1888 again. Okay, now it's time to unwind this short position. It's time to cover the short. In order to cover the short, I just do the exact same procedure in reverse. I borrow USDC. I go to 1inch or to Pancake Swap or Uniswap, and I swap the USDC for cheap ETH. And then I pay that ETH back to Aave. So we'll use the other button this time, now that I figured it out. One day I'll just remember it. Now we're swapping 2 ETH for 3,777 USDC. Actually, the other way around. We're borrowing 3,000 USDC, swapping it for cheap ETH, and then paying this loan back. So now, watch these two numbers again. The ETH debt went down, and the USDC went up. It went down 2 ETH, and it went up 3,777 USDC. Let's do it again. So let's say I just unwind the whole short position. I just keep buying the cheap ETH. I think it's bottomed. I just want to be fully long again. Boom. Now remember, we started this whole exercise and I was $60,000 in debt. What's my debt now? $49,500. So that's a net profit of about $10,500. And the only thing I did was manipulate my debt. Okay, so that's the second strategy. And as you can see, here's my current Aave position today. I'm pretty sure I was in debt to the tune of, maybe it was 24 ETH, somewhere between 20 and 25 ETH, because I had that short position. And you can see I've unwound some of that debt. I still have some ETH debt. So I still have a fairly small short position. I've already closed out my short positions on GMX. That was done back at $2,000 ETH. But then over the last couple of days, like yesterday, the day before, I've been taking advantage of this sell-off, buying myself some cheap ETH with borrowed USDC and unwinding this short position. Okay, so those are the first two strategies. The third strategy is our cash flow engine. Now, we've done several videos on this, including one that I'm working on right now. It should be released very soon. But if you go to our YouTube channel, this is going to be your best source in terms of how to create a liquidity position. I take you through every single step of the process in this video. And this is our cash flow engine. This is how we generate cash flow every day in DeFi. We provide liquidity. Now, let's talk about what happens to a liquidity position when the price drops, okay? And that study that I showed you, this report that I put together with Claude over the weekend, most of the loss, actually, you can see that. Here are the 7 liquidity positions that I ran from November 21st up until just this past weekend. And you can see the fees that I generated off of each position. This is the capital that I put into each position. I always put borrowed capital into my liquidity positions. By the way, that's another hack where instead of putting your investment capital into a liquidity position, just borrow capital. That way you can have, let's say you have $100,000 in Bitcoin and ETH. Leave that there. Don't sell it to do a liquidity position. Put it into Aave, collateralize it, and then borrow cheap capital. That's our DeFi carry trade. We borrow capital anywhere from 2 to 4% interest. So we borrow capital at a very low interest rate, and then we put that borrowed capital into a liquidity position that earns a very high yield. We're talking about anywhere from 5 to over 10% per month. So typically somewhere around 60, 80, 100, 120% annual rate on these liquidity positions. So we borrow low around about 4 or 5%, and we earn high around about 80 to 120% per year. And that's our DeFi carry trade. Borrow low, earn high. Trademark. Hashtag borrow low, earn high. Anyway, this is the capital that I deployed into each position. This was just a little one-sided position that really wasn't kind of the main show. But you can see the fees that were generated each time. By the way, this is fully transparent on the blockchain. This is backed up with I have a full CSV file that goes with this, all the transaction hashes. This is transaction hashes. This is fully verifiable. I'm not just making these numbers up. These are all the principal gains. So the first 6 positions actually worked out in my favor. And that's because the price was grinding higher. And it wasn't until mid-January when I started this position where we got that big drop, right? And so I was generating fees and capital gains on those first 6 positions. But when the price really crashed from mid-January down to February 5th, this is where the loss came. So that's how it worked. Now, a lot of people, I think it's kind of a misnomer, but when people talk about providing liquidity, they will say, oh, you got to watch out for that impermanent loss. What about the IL? Watch out for the IL. You're going to lose money. And it's not, I don't like that phrase. It's not really accurate. I really think of it more as it's trading. It's a trading loss. So let me explain that. Let me zoom into a 1-hour chart, and then I'm going to show you my ranges. So this set of drawings, these are a bunch of rectangles, and each rectangle represents my concentrated liquidity position and the range that I had on that. If you don't know what I'm talking about, watch that video right over here. Your crypto pays you. 16.5 minutes. Watch that and then come back. But I set up, where am I? I set up my ranges, and this got started. Let me zoom out a bit here. So right here is where it all started, and this was the January 14th position. That's this one right here, which ended up being the big loser. But that's okay, because I offset that $30,000, $31,000 in losses. It was completely offset by the hedges, the short position, the Aave short position, and the fees that were generated the whole time. So this is the third strategy, is generating fees from a liquidity position, even when the price is dropping. So think about this. This liquidity position here, I started this when ETH was about $3,000, $3,350 per coin. Okay, then what happened? Then the bottom absolutely fell out of this market. Massive crash. Literally started the day I started that liquidity position. So no wonder I lost money on that position. Of course, if you put money into Ethereum and then the price drops, let me get this out of the way, and the price drops 45%, well, of course you're going to lose value. How can you not lose value as the market is crashing 45%? A liquidity position is no different. And let's talk about the mechanics of it. So when you provide liquidity, you're putting your tokens into a decentralized exchange liquidity pool. And in my case, I was doing ETH and USDC. So that's the token pair. And I provided my ETH and I provided some USDC, and I put those two tokens into the pool. And once I have my money in the pool, now it's up to the traders to decide what's going to happen with the price. And every time a trade happens, it's my position that's taking the opposite side. So let me flesh that out. If a trader connects their wallet to Uniswap and they swap their USDC for ETH, they're buying ETH. What happens to those tokens? The trader sends their USDC to the pool, and the pool is managed by a smart contract. And so the pool sends the trader ETH. So USDC goes in, ETH comes out. So on the other side of that is the liquidity pool. As a liquidity provider, I am part of the liquidity pool. To say this in a simpler way, if a trader buys ETH, I'm selling. My liquidity position is the one that sells the ETH to the trader. Likewise, if a trader sells ETH, they're selling ETH to the pool. They're sending ETH to the pool. And the pool is going to send back USDC. So as the trader sells ETH, my liquidity position is buying ETH from the trader. It's not just my position. It's everybody that's providing liquidity for that pool. But the effect on me as a liquidity provider, if traders are buying ETH, I'm the one selling ETH to the traders. And if traders are selling ETH, I'm the one that's buying, right? So when I loaded this position, I had to put USDC down here and ETH up here. So if traders start buying, what's the price going to do? It's going to go up. So if the price starts going up through my range here, I need to have ETH. Think of this as two shelves in a store. One shelf has ETH, one shelf has USDC. This is my ETH shelf here. Because if the price starts going up, that means traders are buying ETH. I need to have ETH on that shelf to sell to the traders. So I loaded this portion with ETH. The other portion was the USDC. If traders start selling, the price is going to go down. I need to have USDC to buy ETH from all the traders. Okay, so I load that up. Now let's zoom in and let's see what happened. So I loaded it up roughly 50-50, okay? I think this position was originally about $40,000. I put about $20,000 of ETH and $20,000 of USDC into the position, and then the price crashed. So as the price is going down here, traders are selling. My position is buying ETH from the traders all the way down. By the time the price gets to the bottom, I don't have any more USDC in the position. That shelf is gone. It's empty. Instead, I have 100% ETH in my position. So my position converts to ETH. Now, when I started this, the $20,000 of ETH, I paid maybe $3,350 for that. Then as the price was dropping here, I was getting a little bit of a discount, right? The price is going down and I'm buying ETH from the traders at lower and lower prices. But right here, it's done. I already bought all the ETH. I don't have any more USDC. At this point, right here, my liquidity position is no longer really a liquidity position. Now it's just a bag of ETH. Okay. And if the price keeps dropping, which it did, I'm now riding that ETH all the way down. Now I can move my range. I can close out the old position and put a new position with a different range, get back in on the action. But the same thing kept happening over and over and over again. Now, once in a while, you can see here, I caught a pretty nice bounce. For several days, I moved my range down to here and the price started bouncing. And as the price is inside of my range, that's when I'm collecting the fees, right? I forgot to mention that part. Whenever a trader trades, they have to pay a fee for that service. That's why this is a legitimate business. Providing liquidity is a legit business. You're providing an ability for traders around the world to trade these two assets with each other. It's not only a legitimate business, it's a growing business. This is growing. Online, or excuse me, on-chain decentralized exchanges is a massively growing business. It's only going to continue, especially as we get into the AI and the machine economy. Machines don't use banks. Machines use crypto. But that's another story. Anyway, when the price bounces and hangs around in my range, all of those swaps that are taking place, I get a little cut of the fee every single trade. So I'm generating cash flow from this position when other people trade. It's beautiful. But as nice as it is, and I believe this position at the moment is something in the area of more than $12,000 in fees that I've collected just from this position alone. I've captured enough price action on the way down to generate about $12,000 in fees. Now, also, the value of the position went from $40,000 down to $10,000. It lost $31,000 of value. So that's a real loss. And that is a real risk associated with providing liquidity. If you provide liquidity, you're putting your money into the market. If traders sell that price down, you're going down with it, right? So that's why when you're going to provide liquidity, you have to recognize the market environment. And for us, we recognized it back in November 21st, that massive drop. We said, this is different. This is no longer just a pullback. This is now a legitimate bear market. We need to start implementing some hedging so that we can offset our losses. And like I said, with that report and my actual track record of managing this particular wallet, this is my wallet that ends in AA12, the fees that were generated, as well as the profits that were generated by the hedging, not only offset the loss on that LP, it actually ended up netting a net profit. So you have to recognize the market that you're in, the environment that you're in. And I mean, it couldn't have been clearer when you zoom out on this chart and you look at like a daily chart. Like it doesn't take a price action trading guru genius to figure out what's happening. Like it couldn't be clearer. It's just lower low, lower high, all the way down. Now we did go sideways for a little bit, so I wasn't 100% certain. You never are. But like I said, once we had this massive drop into November 21st, this is when I started preparing for the chance that there might be another drop. And sure enough, it did. So I wanted to generate cash flow. I wanted to run a liquidity position, but I also needed to offset that risk. I put $40,000 into the position, and I knew that it would massively lose value. I didn't think we would drop 45%, but that's what happened. and that's why the value drained out of that position. I also had leverage applied to that position to boost the yield, but that's a story for another day. So that is the third strategy. 3 strategies to make cash, make profits in a bearish market. Number 1, you can short these assets on a perpetuals futures exchange. I like GMX a lot. Fees are kind of high, so I'm in the market for a different exchange. Number 2, you can short the volatile asset on a lending protocol. You can borrow the volatile asset. In my case, I borrowed ETH. I sold it for USDC and paid down my USDC loan. And then after the price dropped down, I was able to wipe out a bunch of my debt in dollar terms because I was able to buy back that ETH at much lower prices and pay back my ETH loan. And number 3, you can run this in any kind of market. You can run a liquidity position. Doesn't matter if it's going up, down, or sideways. The name of the game as a liquidity provider, let me zoom in on a 1-hour chart and go right over to the right-hand side of the chart. I haven't moved my range down recently, but the name of the game for a liquidity provider is to capture price action. The more price action that you can get to happen inside of your range, that's when you generate the fees. When the price escapes your range, like it did right here, you stop generating fees. So this is why when the price dropped down here, I went ahead and moved my range lower. I was hoping for at least a little bit of a bounce so I could generate some fees before it dropped lower. Didn't get that. I think it bounced for about 10 minutes and then it dropped lower. Same thing here. I snuggled my range lower and it just kept tanking. So right now I'm just leaving this position in place. I'm thinking we might get a decent bounce, at least some kind of a relief rally. We've already hit a pretty nice, pretty clear sort of a double bottom here. We did go a little bit lower just yesterday on ETH, going below that February 5th low, but close enough to call this a double bottom. And so we'll see. I'm kind of thinking that we might get a little bit of a bounce, but anyway, those are the 3 strategies. So I hope that helps. And it really is amazing with DeFi, the ability to kind of deal with any type of market, the composability, the way that we can customize that debt position on Aave, for instance, the way we can generate amazing, great yields on these liquidity positions. 40,000, I put 40,000 in and I've made about more than $12,000 in fees. And it's been, let's see, January, February, March, April, May, not quite 5 months. So what, $2,500 a month off of a $40,000 position? Do the math. These yields are pretty fantastic. And as long as you know how to hedge your position, you can actually not only protect your value, but you can actually profit as the price drops down. Let me see a couple more questions. Very small account, start with 1.5 ETH. That's not small. That's another beautiful thing about DeFi. You can start with $100. You can open up a liquidity. I did a demo wallet. I'm using a demo wallet for these videos over here. This video and this video, I'm using a $120 demo wallet. The video I'm working on right now, I opened a $60 liquidity position. Listen, the yield is the yield. So if I'm telling you, or if you can expect to earn somewhere on the order of 5 to 10% per month on your liquidity position, it doesn't matter if you put $100 or $100,000. The numbers work out the same. The percentages are what they are. And so this strategy and this financial system is available to all players, no matter how big or small your wallet is. So 1.5 ETH is a great place to start. Does the capital generation have compounding effect to reinvest the gains? Yeah, no, don't say sorry for asking questions. I love it. Yeah, so what I like to do, my main liquidity position, as I explained here, is in ETH USDC. So as a provider in ETH USDC, the swap fees that traders are paying are ETH and USDC. So as a liquidity provider, my yield comes in the form of ETH and USDC. So every time I go and collect my fees, it's roughly half and half. I'll get 20 bucks in ETH and 20 bucks in USDC or whatever it is. Now, what you can do, what I like to do, if I don't need all of that cash flow, which, sometimes I just take it. I collect my fees, and then maybe once a month or every couple of weeks, I'll remove some of that capital from my wallet. I will off ramp it. I'll take the USDC and I'll convert the ETH into USDC as well. I'll send the USDC to my Coinbase account, convert it to dollars, and withdraw it to my checking account. I did a lot of that so far this year, just to pay everyday bills, rent, groceries, car payment, etc. But if you don't need all of your yield, it's very handy that your fees come in the form of USDC and ETH. Because what I like to do when I don't need all the fees, the USDC, I'll take that. I'll send that over to Coinbase, convert it to dollars, out it comes to my checking account, right? The ETH, I like to stack that. I like to stack it up because my opinion is ETH is going way higher in the future. We have the AI economy. We have everything is being tokenized. We have the entire financial system is moving to the blockchain. I was just talking with our community today. The prediction for AI agents is 80-1, meaning for every one human, we're gonna have 80 agents. And I totally believe that. My business partner has been working on our app and upgrading the app to now includes Sui, which is a completely different blockchain. Anyway, the other day, we were just talking yesterday, and he did a project to completely validate the code base of our entire app. His Claude spun up 162 agents. He just said, look, I want you to completely review all of our code base, make sure there's no bugs, make sure it's all secure, blah, 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 blah. And Claude said, yep, okay, here we go. I'm going to spin up 162 agents. So my business partner is kind of breaking that ratio. My point is, we're headed to a world where for every human financial participant and actor, we're going to have 80 agents. These agents are going to be conducting transactions. They're going to be conducting business. They're going to be using the blockchain to process tokens, to get data, to make payments, and on and on and on and on. So the future is so enormous when you think about the machine economy, and everything is going to be on chain. So I do believe, for those reasons and other reasons, that Ethereum is going to go massively up in the future. I think Ethereum is going to be one of the biggest winners in terms of the entire financial system on blockchain rails, right? Raoul Pal says, buy the rails, own the rails of the future machine economy. It's a unique opportunity in history for us to be able to invest in the infrastructure of the coming financial system. Anyway, I've rattled on enough about that. What I wanted to say to you is that you can stack that ETH and just let that compound. Now, once you build up enough extra ETH, you can collateralize that, add to your collateral over here, which then unlocks more borrowing power, right? This is velocity here. This is, I have $102,000 of crypto that's working for me. If the prices go up, I'm making money over here. But in addition to that, I have roughly $60,000 in borrowed capital, which I have deployed in different opportunities. Some of that borrowed capital, I use that to invest in other crypto assets. Some of it I put into liquidity positions. Much of it I put into liquidity position. I have position on ETH. I have positions. I have a position on Sui. You name it. So I've increased the velocity. Instead of just $102,000, I have $162,000 working for me because I'm taking this borrowed capital and I'm using it to generate daily cash flow. This is the secret sauce. It's not so secret, but this is our recipe for making money in crypto and DeFi. We buy the assets because we believe in them long term. We think the numbers are going up in the long term. 1 to 5 years out, to 10 years out, these prices are going to go higher, and we're going to make mad gains on our treasury assets. But while we're waiting for that narrative to play out, we might as well generate some cash flow. We'll engage in the DeFi carry trade. We'll borrow money for 4.3% and take that very same borrowed money over to Uniswap and generate 5% a month or more. So borrow low, earn high, increase the velocity of your investment collateral, or your investment capital. So even if your entire investment capital is 1.5 ETH, you can get started with that, and you can absolutely compound the gains. So great question. Yeah, I mean, it wasn't unexpected. So it wasn't like I didn't know or didn't believe strongly that the price was going to drop. But at the same time, it didn't have to drop. It could have gone sideways, in which case I would have earned a ton of money. See, this is another awesome thing about liquidity positions. If the price is going up, your liquidity position really doesn't do much, because every time the price goes up, it escapes the top of your range, you stop earning fees. But if the price is going up and you have spot assets in your treasury, like we do in Aave, that's going up. You're making money as the price goes up on your spot assets. But then when the price takes a breather and goes sideways for a while, your spot assets aren't doing anything. The price is the same. You're not making any money on your spot. But whenever the price goes sideways, guess what it's doing? It's staying inside your range. It's swapping up and down, or gyrating up and down, but it's staying in the range more or less. You're generating fees the entire time. So it's the best of both worlds. And also, if the price drops, well, okay, your treasury is going to take a hit. Can't do anything about that. You're holding on to these assets. Your mindset is long-term. You're thinking, okay, 2030, 2032, these assets are all going to be way, way higher. I just have to stomach this drawdown in the meantime. But you can hedge, make some profits on the way down. You can short it on GMX, make some profits on the way down. You can run a liquidity position like I did. I'm not exit liquidity. I'm a liquidity provider. This is borrowed money that I deployed to earn cash flow. And I did. I earned to the tune of more than $12,000 of cash flow as this dropped down. Now, the value of my position went down more than 12,000, but the value of my hedges went up by more than 12,000. Went up a lot more, right? So you can have an expectation, you can structure a portfolio, you can structure your hedge positions, etc., to actually benefit from that. So you don't necessarily have to be exit liquidity. Although that is very, I mean, you're pointing out a very, very typical, very true thing, you know, that does happen in a lot of assets. I mean, just look at meme coins. A lot of the meme coins are just down 99%. Yep, thank you for that. DeFi carry trade. Trademark on that. Still confused about your position 7, though. How do your gains count and your big loss doesn't? It does count. But what we're looking at, we're looking at the portfolio holistically. Okay, so let me go back to the report. So, so first of all, there's a limited scope here. This is basically as soon as we realized that we're in a bear market, which was that big drop on November 21st, that's when we started implementing hedge positions. Prior to that, we were in a bull market. There's no reason to hedge. You don't really want to be short when you're in a raging bull market, right? So the scope is basically 6 months, from the end of November to the end of May. Okay. Now, during that 6-month time frame, I ran 7 positions. You can see the date windows each time. Okay. Each of these first 6 positions made money, generated fees, and the price was trending higher during those time frames. So the value of the liquidity position actually increased. I didn't mention that. It doesn't always have to go down. If the price goes up and you're running a position, you're actually going to gain in value. Now, a liquidity position doesn't do a great job of capturing that price appreciation because it's selling the whole time. The price keeps going up, your position keeps selling, right? Traders are buying, you're selling. So it doesn't capture a lot of the price appreciation, but it does capture some. Okay, so that's what happened the first six rounds. You could say is I kept putting capital into the position, generating fees, and actually generating some small gains. January 14th was literally the top. So I put that $41,000 in there. It's a little bit less. I added some capital on the way down. Put that in there, and I mean, not immediately, but pretty quickly, within 3 weeks, the sucker crashed 40% plus, right? So this is where the value was lost. But as of May 31st, this position had generated $12,500 in fees. So as that price is dropping, I'm capturing price action. I adjust my range. I capture little bounces. There's trading that's happening inside my range before the next plunge, right? So you're generating fees the whole way down. Altogether, over the 6 months, $15,765 in fees. Okay. The gains here, right, in the first 6 positions, massively offset by the loss there on the January 14th position. Okay. So lost 30,500, but made 15,765 in fees. That's the first part. I also was longing and shorting on GMX. So I was strategically trading GMX. A hedge doesn't always have to be short. You can actually hedge to the upside, which I do that sometimes when I'm expecting a vicious bounce. So total profits generated on GMX through my hedging activity, 21,800. I also, you might not have been here for the discussion of Aave, but I also implemented a synthetic short position on Aave, multiple positions. I shorted a bunch into late November, early December, cashed them in the big drop at the end of January. And then I started re-shorting as we were rallying from the February 5th low up until March and April, and then getting some profits in this latest drop up until including up to May 31st. And so the profits generated by shorting the market on Aave, 18,800. So holistically altogether, there it is right there, combined result. Fees, lost principal on the LP, profits on GMX, profits on Aave, total profit of $25,000, almost $26,000. So hopefully that clears up the confusion. Thank you for the question. How do you track all these shorts, trades, earn fees? Great question. Yeah. So for taxes, I use a software program called Coinly. And that's one of the things we do teach in Overseas DeFi if you sign up for our accelerator program. So we have two offerings at Overseas DeFi. Number one is the Overseas DeFi community. This one is only $97 a month, cancel anytime. You get the training, you get the AI, and you get the portfolio tracker, which is a complete custom app that we built here within Overseas DeFi. You can connect your wallet and keep track of all of your positions within this one spot. So this is part of the answer to your question. The other part of your question for taxes, again, I use Coinly. So Coinly brings in all of the transactions. You sync it with the blockchain, all your different wallets. It is some work to that, to keeping up with it. I keep up with it on pretty much on a daily basis. I just sync in my latest transactions and review them. And what Coinly does is it really just divides the transactions into 2 buckets. So you got your trades, and at the end of the year, all of your trades, that's going to figure out your capital gains or loss. And the other bucket is your income and your expenses. So whenever I provide liquidity and I collect fees, I tag that as a reward within Coinly. That goes into the income bucket. If I pay a gas fee, that goes into my expense bucket. And at the end of the year, I get a report from Coinly that says, here's all your income, here's all your expenses, and I treat it like a business. But yeah, there's some work to it. There's my business partner, Roman. Yeah. This is, and by the way, this is constantly being improved. Like I said, Roman, my partner, spent some time this week, including spinning up 162 agents on Claude to completely go through this entire code base. But he just added the suite capability. So now it used to be we could only track our portfolios on the base blockchain, Ethereum, Arbitrum, and BNB chain. Now you can also track your SUI positions. I've been working on something called the fee tracker when you asked about the fees. And so what this does is it has your complete history of the liquidity positions. I still have some bugs to work out. This is totally not accurate. There was no net P&L loss of $8,500. So still got some work and some bugs to work out on this fee tracker. But the idea here is you can keep track of your full position. This is the position that I've had open since January 14th. Every time I move the range, every time I collected fees, every time I borrowed against it or made a deposit or a withdrawal, everything is tracked within this. It tells you your yield. Whenever you collect fees, it keeps track of your average yield over time. Obviously, this position has diminished in value, so the fee revenue isn't what it used to be. But if you look at the very beginning, the fees were crazy before that big drawdown started to happen. My batting average on this was over 150%. It's actually over 180% early on, even down into the February 5th low. So anyway, yeah, this is the app that we use to keep track of all of that stuff. And it just keeps growing, keeps getting better, new features, new functions. I showed you guys, you might have missed this, but we have the whole lending and borrowing simulation here where you can play out all kinds of different scenarios with what the price does, and are you going to get liquidated or not? How much could you borrow? That sort of thing. It's all here in the app. When I go to, oh, you guys are having a little conversation here. Just go. I posted this in the beginning of the chat, but just go to community.overseasdefi.com. So community.overseasdefi.com. There is my good friend Roman, the co-founder of Overseas DeFi, and you can sign up for the community. Like I said, $97 a month. We actually have a free trial going on right now, so you can sign up for this for 7 days, absolutely free, no risk. Jump in there, use the AI, connect your wallet, look at your portfolio, play around with the different tools. Ask questions, watch through all the training videos. We have like 17 video lessons in there. And we even do a weekly Q&A. If you're in the Overseas DeFi community, once a week, we do a private sort of a live stream, kind of like this, but in private in Zoom, and you can actually ask your questions in real time. I'll be there. Roman will be there. And we can help you figure this stuff out. So, that's what you want to do. Go to community.overseasdefi.com. Oh, nice. Yeah. Like he's a beast. Roman, I mean, kind of ADD, like, but works so hard. He's constantly making improvements. And it's a match made in heaven. Roman with Claude AI, holy crap. The productivity is off the charts. So anyway, I think that's about it. Lending, yep, all that's covered in the app. No worries. Thanks for tuning in. And we do this every week. So Thursday, 6 p.m. Eastern, live stream here on the channel. Make sure to subscribe to the channel and turn on those notifications. In our case, we actually do a live stream every week. So you want to get notified and you want to be informed whenever we go live, so you can come in real time and ask a question and get an answer. So thank you guys so much for tuning in. If you're watching the recorded version, make sure to like the video, leave a comment down below. And thank you so much for watching. I'll see you guys next time.